We're here with Jim Wyckoff, senior market analyst at Kitco News, and we're going to be talking about the big moves in the gold and silver markets. Jim, good morning.
Good morning, David.
Let's take a look at the charts first. So here we have a one-year gold chart. Now, as we can see, over the last few days, gold took a massive drop from the $1,900 level all the way down to $1,779 right now as I'm looking at the screen. Now, we are up a few dollars today, but it's barely a move. It's kind of flat today as we speak on Friday morning. Silver as well. Let's take a look at the silver chart. Another big drop. So all of this happened in the last few days, Jim. What do you think happened in the last few days that precipitated this drop?
Well, David, the main event of the week was Wednesday afternoon's FOMC meeting being concluded. The FOMC statement, Fed Chairman Powell's press conference, all pointed toward a more hawkish U.S. Federal Reserve monetary policy, and that really rocked the landscape of the marketplace, impacted many markets, including gold and silver. You saw the U.S. dollar index rally strongly. Other currency markets, produced big counter trend moves, and all of that on a near-term basis worked against the gold and silver markets. The fact that up until Wednesday, the Fed had had a tenor of easy money policy. In fact, that dates back many years. And the fact that gold and silver prices in previous months and years had been rallying on that easy money fix, so to speak, the fact that traders thought that will be coming to an end led a bearish tone to the marketplace, and prices sold off sharply.
Okay, let's revisit the FOMC's statement this week. Jerome Powell did keep the rates at where they are currently, so he didn't raise rates immediately. So what specifically about that statement made you think, or made the markets rather think, that the tone turned hawkish?
Well, we've been talking for some time about the timing of when the Fed might make their next policy adjustment by tightening or raising interest rates. And the Fed kind of tipped its hand Wednesday by saying that maybe late 2022, but probably into 2023, you're going to see the first interest rate increases by the Federal Reserve in many years. And the marketplace had been expecting that, but the market got it. Also, the FOMC statement and the Fed so-called dot plot showed a little higher inflationary pressure than the marketplace expected, showed a little stronger U.S. economic growth. Also, the Fed, in the statement and also in Powell's press conference, the Fed really doesn't know how inflation is going to play out in the coming months or few years, and that kind of unnerved the marketplace a little bit. All that worked to produce some anxiety. And like I said, the gold and silver markets in previous years had been, fixated on the bullish aspects of an easy money policy, providing more demand, more consumer spending to buy precious metals, more commercial demand for metals. And the fact that the Fed wants to now tamp down on money growth and raise interest rates to maybe squelch demand a little bit, that all put a near-term bearish perspective for gold and silver traders. However, importantly, David, I look at it from a longer-term perspective, and when you see the Fed tamping down monetary policy, raising interest rates, that's because of demand that they fear is going to be stronger than expected, and that includes for commodities. So in effect, we've seen this easy money policy over the years that has worked to provide more consumer and commercial demand to keep economies afloat. We're going to see that same demand occurring, maybe even stronger, because of stronger economic growth. And the fact that the Fed wants to tamp it down a little bit, in my mind, is not a big situation on a longer term basis, because we're still going to have that good demand there for raw commodities, including the metals.
You're right, Jim, and it's not just a bit. I think some market observers would point out the fact that the Fed has hinted 2 rate hikes, not just 1, but 2 rate hikes,
right,
by 2023. So they're
Right.
really trying to ramp up monetary tightening. Now, I'm just putting my shoes in the putting myself in the shoes of the Fed now. Why wouldn't I space it out? Why would I take two rate hikes in the span of just a few months? Why wouldn't I start now and then slowly ramp it out over the course of the next 2 years?
Well, the Fed always takes a gradual approach, and the Fed wants to be transparent. And their notions about what their monetary policy might be in 2022 and 23 could certainly change. Fed policy notions have changed just since the March dot plots were last released. So, in a few months, we could see a further, more aggressive approach by the Fed on raising interest rates. And that wouldn't surprise me, by the way. So this is the way the Fed is thinking right now. They want to be open about it. The markets reacted, but the Fed could change their mind, at the next FOMC meeting or the one after that.
Now, I'm just wondering why gold and silver would react negatively to this hawkishness. We do know that there is an inverse relationship between gold and interest rates, that we know, but we also do know that there is a relationship between inflation and gold. Specifically, real interest rates affect gold. So do you think that inflation would not rise at the pace of interest rate rises over the next 2 years?
Well, David, I've said this in my AM and PM reports, and I've said it on your show too. Traders are fickle. Shorter term traders are especially fickle. And it was a knee-jerk reaction to push prices sharply lower. My bias is that on a longer-term basis, you're going to see a continued price appreciation in the metals markets. Look at what crude oil has done this week. New 2.5-year high in crude oil prices, the leader of the raw commodities sector. That's a bullish element for the raw commodity sector, including the metals. I think that, like I said, traders are just fixated right now on the heretofore easy money policies of the Fed and other central banks. And now that that's changing, the shorter term traders are, trying to adjust to that. But on a longer term basis, I think the demand will be there that keeps raw commodity prices pushing higher.
Now, you did mention the dollar, Jim. Let's take a look at the dollar chart one more time. That is a significant increase over just a span of 24 hours. When you look at that chart, Jim, what are some of the first questions that come to your mind as a trader?
Well, it comes to my mind, can this surge in prices be sustained? Certainly the near-term technical posture for the U.S. dollar index has improved the past 48 hours. We'll see if that can continue. Importantly, when markets make big price moves, like we've seen, then we typically see a pause. We're seeing a pause today. Importantly, next week will be, can these markets continue those price moves in the direction in which they went late this week? That remains to be seen.
Is the dollar one of the more significant factors you're looking at right now when analyzing the gold market? Because I do observe a very strong inverse correlation over the last couple of weeks, perhaps even months.
Yeah, I mean, we got to watch the dollar pretty closely, and we'll see how that the dollar index trends over the next few weeks. My bias is it's probably not going to trend sharply higher, maybe sideways to higher, maybe sideways in the coming weeks. And the gold and silver markets and the other metals markets are going to react to that. Most raw commodity prices on the world market are priced in greenbacks, and when the dollar appreciates, it makes those commodities priced in dollars more expensive to purchase in non-U.S. currency. So that's the correlation there.
One of the things that drives currencies is interest rate differentials between countries. So as we've seen hawkishness from the Federal Reserve, do you expect similar hawkishness from other central banks around the world that could also drive their interest rates up?
Yes, I do. In fact, we're starting to see some of that already. We're starting to see posturing by some of the major central banks that are mimicking the lead that the Fed has taken and just saying, hey, now is the time to put the brakes on this quantitative easing and start to roll that back. Keep in mind, David, there really isn't much direction, or there really isn't a direction that monetary policy can go in the coming years than up. Interest rates are at or near zero or below zero in some countries. it just can't get much. You can't get much more easier money policy than we've seen in the past few years. And when economies do start to recover, you're going to see those monetary policies start to tighten up, and that's a healthy thing. The Fed has said that's a healthy thing that we're seeing interest rates start to rise again.
Okay, so if I interpret your message correctly now, Jim, you don't expect the U.S. dollar to continue taking the lead like this for the foreseeable future 12 to 18 months. Is that correct to assume?
Now, what I mean is that we're going to see how price action goes next week and the week after that. 1 week does not make a long-term trend. Let's just see how this dollar index performs over the next couple of weeks, over the next month. If the trajectory continues to be up, then we've got a significant change in trend, and the dollar could be a significant impact, let's say more of an impact on the raw commodity sector. But right now, we're just going to wait and see what happens. My bias is that you're going to see more of a maybe sideways to higher price action in the dollar, and that the dollar will continue to be in a situation like it has been recently. Certainly an outside market factor that bears watching, but not an overbearing, not such an appreciating dollar that it's overbearing and completely squelches, demand for raw commodities priced in dollars.
Sure. And let's go back to gold and silver now, and we'll talk about the price levels. We did see, again, a big collapse, or if you want to call it a collapse, a big fall in prices over the last couple of days. We're reaching 1777 right now as we speak on the screen. Is this a support level for you, Jim? Because you did call this a knee-jerk reaction.
Well, the support, near-term support in the gold market is at this week's low, and as I look at my chart, that would be 1767.90, and that's July futures. So that's important near-term support. If we take that out, there's probably some sell stop orders in the futures market that lie underneath that'll push prices lower. Then you've got 1750 and then 1700. Like I said, it's not going to surprise me to see some more, near-term price pressure on the gold and silver markets. But importantly for our Kitco readers and viewers, look at the longer-term monthly and weekly charts. They still show gold and silver prices trending higher. By a monthly and weekly chart, I mean a bar chart that showed that one bar is 1 week's price action or one bar is 1 month's price action. What those longer-term charts do is clear out the noise of the day-to-day charts or the daily market machinations that many times just, is market noise on a longer term perspective.
Mm-hmm. And silver now, Jim, what are the key levels you're looking for silver?
Silver prices, if we could get above $27, that's going to give the bull some fresh footing, maybe to stabilize the market. And then you're looking at resistance at 28.
Mm-hmm. Excellent. Jim, thank you so much for your update this week. I look forward to speaking with you soon. Thank you.
All righty, David. Take care.
Have a good weekend. And thank you for watching Kitco News. I'm David Lin.